you very much. As I always say, the check's in the mail, Mike. Thank you. Thank you so much. Yeah, what a good looking crowd. Well, I've got about 60 minutes to jam into 22 here. So let's get started. I like to start with a year in review here. So artificial intelligence hit mainstream in 2023. Now, we have invested in this segment in two of the leading companies for a number of years now. AI was a huge story and helped power a bifurcated market in 2023. Now, there's a couple of AI generated or fake generated slides that are be coming up here in my presentation. I'm going to trust this is a very sharp crowd and you can spot those. So we'll see if we can play a little game. Reviewing 2023. Now, Barbie was the biggest grossing movie of 2023. And as I have an 8-year-old daughter, it was the most talked about movie in our house, and we watched it a lot. It was great. It was great. Daddy loved it. Now, the film took on a lighthearted swing at patriarchy. And despite being created, written, produced, and edited and starred in by thousands of women, ironically, yes, it was Ken who was nominated for an Oscar. Literally the only dude in Barbie land, and he gets nominated. Impressive, right? Patriarchy. I thought it was gone, but we're back, right? Oh, great. I'm kidding. But Mattel is so proud of Ken, so proud of Ken. Now, I'm going to ask you, is this fake or real? Sadly, this is real. Mattel in 2009, they came out with a doll called Sugar's Daddy. Now, it got me thinking, what were we doing back in 2009? Well, we had recommended a couple of companies then. And, you know, I thought, and don't shoot me for this, if you had been recommended or invested in just one of these companies, I am just hoping we haven't created any real life sugar daddies or sugar mummies, because they could have done that, the investments that they had in these companies. Now, alas, another shocking stat from 2023. This is the most shocking, to be honest. My local hockey team, the Vancouver Canucks, a dumpster fire for about a decade, started winning. And I say that with a question mark almost still, because I can't really believe it. But there it is, #1 in the standings, unbelievable. And 5 all-stars on the team. Actually, this is out of date. We just traded for another one. We have 6. The mascot, the coach, and the announcer were there. Unbelievable. Of course, we all know how this will end, but it could be a fun ride, right? Let's just not torch the city this time. That would be great, wouldn't it? Although if we could win a Stanley Cup, I'd take a couple finals. That'd be okay. Finally, we have the drama that's going to unfold in 2024, the election to look forward to, Biden versus Trump. Now, according to Ron Burgundy, the real problem with this election is that one of them is going to win. Again, don't shoot the messenger, Ron Burgundy said this. Although ChatGPT does tell me that these two guys outside of the campaign trail, they're the best of buds. Camping buddies, who knew? This one I really love. Okay, those are fake, right? We've identified the fakes in there. That's about it. Isn't it cute, the sweaters? All kidding aside, though, when I joke about the electoral choices in the US to my American friends, they always remind me, at least they don't have to endure this jam. So, okay. I'll just let that one breathe, right? Yeah. So when I was contemplating what to talk to you about this year, I thought I could get up here and forecast where the TSX would be in a year, the price of Bitcoin, natural gas, or Costco's hot dogs. I'll give you a free advice on that one. It'll be $1.50 and you'll get a Pepsi. Now, these forecasts may or may not be helpful to you, but they really pale in comparison in terms of the impact that you have on your wealth and your portfolio. The biggest issue that I see in Canadian portfolios, and this is essentially the structure of those portfolios. Ironically, poor structure is what is apparently kept the Canucks from fixing themselves to 2023. They've gone from zeros to heroes. Now, my dad and the 6 other hockey nerds in this audience are peeing themselves at that joke. The rest of you are saying, what the HE double hockey sticks is this guy talking about? It amuses me. That's why I say it. Now, I'm going to give you 4 to 5 stocks that you can help, that'll help your portfolio shortly. But today we're going to start with a simple piece of advice on the basic structure of a winning portfolio and why conventional wisdom often gets it wrong. But let me start here by saying, why are you here? Is it the free lederhosen? Could be. I'm not sure. But, and if you did, I did actually take in a few speeches earlier today, and it's not for the jokes. But trust me, it's not for the laughs. Heck, sorry. I know Aaron's standing there. I don't know if I can say this right now, but I said, heck, if you thought those speeches were bereft of a pulse, wait till you see this guy come up on stage right after him. No. You are here to make money, and there's no shame in that. I love making money. It's why you come to these events and you put up with the likes of me. You want to make more money, but most go about it the wrong way. Investors often come to Keystone because they are dissatisfied with their returns and want a better option. I can break it down into the 2 most dissatisfied groups, into 2 broad groups here with 2 common strategies they use. This is, again, if you're trying to beat the market. One is mass diversification, traditional big bank model, or going it alone. Let's focus on the first group here and why the strategy is not working. Number 1 is those who have built their portfolios this way, poorly constructed traditional big bank stock portfolios. These are typically composed of 5 to 20 mutual funds or ETFs. Each owns 100 plus stocks, so you basically own the market, all in the name of that magical word, diversification. Now, the problem is, while diversification is very useful, its application in modern portfolio building has been bastardized, executed terribly. Good idea, poor execution. As opposed to this guy, where it's just bad ideas, bad execution. Now, I will give him one thing. While he definitely cannot balance the budget, he can balance himself. We're all so proud of him, aren't we? And very impressed. With this example of poor execution out of the way, I refer to this chart on optimal portfolio diversification, which displays that by owning 20 reasonably diverse stocks, you've already achieved optimal diversification. And yet, by using the big bank method, investors often own 100 or 1,000 plus stocks. This is poor execution. We see it on a daily basis. This is what we like to call, wait for it, diversification. The more I use that, the funnier it gets, right? All right, back to our slide on traditional big bank equity portfolios. With this strategy, all you achieve is complex, fee-heavy portfolio that mirrors the market but underperforms due to those high fees. Let's look at the number 2, the go it alone strategy, often chasing high returns and ending up with too much risk. These portfolios commonly consist of concept, pre-revenue stocks, junior exploration stocks. These portfolios, if we can call them that, often take on undue risk in misguided attempts to find these blue sky type investments. Most often, this strategy will end in disaster. Now, I'm here to tell you, you do not have to take undue risk to build a portfolio that has a fighting chance to create real wealth. If you want to build true wealth in a portfolio, chase cash flows, not concepts. Now, let's move to a very simple but massively impactful statement that I'm going to make here. Not that one. No, but when you're building that portfolio, what I would have said is less is more, quality over quantity. Let's now move to that. Simple concept here. Investing in just 2 or 3 stocks can be game-changing for your portfolio. But don't just take my word for it. In fact, this past year, Warren Buffett, perhaps the greatest investor of all time, stated that in his 58 years of investing at Berkshire Management, his satisfactory, and we all know they're more than satisfactory results, have been the product of about a dozen truly good decisions. That would be 1 every 5 years. So let that sink in. What are you saying that is only 12 great investments or stocks in his almost 100 years on this planet have made him one of the richest human beings on earth? It does not take many, and perhaps most importantly, they don't have to be the most complicated. businesses out there that promise to change the world. Often they are the most boring, mundane businesses you can think of that produce the best returns. I like to give real world examples. These are the type of boring businesses from our research today here that have produced tremendous results that everybody is looking for. Now, what do these companies do? Like, I present these returns here because they make us look smart. Aaron really needs that. But actually, he's a very sharp man and a large man, so I will remind him that I'm kidding. So, but what do these businesses do? That's my main point. Boyd, automobile repair shops. They fix cars. Hammond, they make electrical transformers. They've been around for 100+ years. Expel, they sell automobile paint protection film, water furnished heating and cooling systems for your home. Not sexy, but the returns are. Having heard this, a couple of questions could come to mind right now. The first one should be, how do I find the next Expel, Boyd, Hammond Power, or Water Furnace? And what do these great stocks have in common? As far as the profile of these stocks that we're looking for, we have literally created 3-hour seminars on this. I'm going to keep it really simple here. You're looking for great cash flow producing businesses with good management that trade at reasonable prices and have a long-term growth path ahead of them. Now, number 2 question should be, how do I construct the portfolio to capitalize on one of these great capital compounding stocks? First, we would say do not build your traditional big bang portfolio model. Even if one of these great stocks makes it into your portfolio, if you have 500 or 1,000+ stocks through ETFs and mutual funds, it doesn't move the needle in terms of return. What we would want you to do, our advice, take control of your portfolio. If you want to beat the market, you cannot just be the market. Create your own simple equity portfolio. We have coined this strategy called focused diversification. We want you to build a 15 to 25 stock portfolio over a 12 to 24 month period. That allows you, it reduces risk and exposure to short-term market corrections and provides flexibility to add to new positions as we come out with new research over time. What would the process be if you became a client tomorrow or started to build your portfolio tomorrow yourself? Start with 3 to 5 initial positions and add 2 or 3 new stocks per quarter as new information is released. Now, in practice, this is an example of what a structured portfolio built with a focused diversification strategy would look like. Now, that's the start of the portfolio, but we're looking for 7 to 10 stocks deployed in each of our 3 core areas of research that Michael talked about earlier. Canadian small cap growth stocks, core dividend growth stocks, Aaron's going to talk about those in a moment, and core US growth stocks. I'm going to put together a simple allocation example for you here. This is if you had a $500,000 portfolio, just as an example. We look here, 20 stocks in that portfolio equally weighted. By equally weighting, I just mean 500,000 divided by 20 gets you 25,000 in each company. Now, again, this is this $500,000 portfolio. 15 years ago, if Boyd was included on an equally weighted basis, today that one stock would be worth $3.3 million. Now, just one stock is literally worth 7 times, just under 7 times the amount of that initial $500,000 portfolio. Literally, all 19 other stocks could have went to zero, and this portfolio would still look to be in excellent shape. Of course, we're not looking to have the other 19 stocks go to zero. We want to bat a good average on those companies and grow those as well. But my point is to show you the truly amazing power that great stocks can have on your portfolio if combined with the right research and a portfolio that is built with this model. The returns are even better if we use Hammond Power, as it is now outperformed Boyd. Okay, I think my point is made there. So where are the opportunities today? Now, this chart here shows the mass influence the mega cap 8, the Alphabets, the Apples, Microsofts of the world have on the U.S. markets, generally speaking. For much of 2023, the market was bifurcated. After a terrible 2022, U.S. indexes performed great in 2023. Canada lagged significantly, though. But the U.S. outperformance was largely due to the strength of the mega cap 8. In fact, while the index was up 25% by November, the other 492 stocks on average were down 4% by November of this year. It has narrowed over the past couple of months, but here you can see the strength of the mega cap 8. So where are the opportunities? If we look here, this is the valuation gap between large cap. If you see the mega cap 8, forward PE or price earnings ratio is 28.9. The large cap's 20. The small and mid caps between 14 and 15. Now to put this in better context here, this is since 2005. The small cap index there is in red. And historically, it's traded at a premium to their larger cap brethren in blue. But we can see today the small caps trade at a significant discount to large caps. Again, this chart will show that the relative valuations have swung significantly in favor of smaller to mid-sized companies. Of course, not all small to mid-sized companies are opportunities, and not all large companies should be avoided. There's some great companies there too, but there is a significant opportunity here opening up for long-term investors in this segment. Now, this past fall, we saw an even more significant opportunity there. We recommended 3 companies. The 3 companies I actually plan to recommend at this conference. Now, the first one was a cash-rich specialty pharma stock. It's jumped 61%. That gap is closing. The cash-rich healthcare stock jumped 44%. The cash-rich fintech, 30%. So I will be recommending a couple other companies today. The first company we're going to get to is Dynacorp. This is a company we recommended here last year. It's up 55%. We've recommended it since it traded back at $1.40. But what does Dynacorp do? They're a miller, not a miner. We don't love mining companies, but they're a miller. They purchase ore from government-produced registered producers in Peru to produce gold primarily, which is sold at international market price. They have a very simple business model. Profitability depends on 2 factors. Number 1 would be a margin between the price of ore purchased and the market price of gold. The higher the margin, the better. Throughput, the more throughput, the better. Also, a higher gold pricing environment encourages more ore to come through, so that's a good environment we're in right now. Now, let's look at why we like Dynacorp. 11 consecutive years of profitability, kind of unheard of in the gold segment. Very strong balance sheet, 33% cash, no debt. It can self-fund without diluting issuing shares. Its cash per share has grown incredibly over time, as you can see there, from 2019 at 20 cents to $1.13. Again, there's no debt on the balance sheet. It is a dividend growth stock as well, which this is what we like. When we originally invested in it, not paying a dividend has increased that dividend or instituted a dividend, now increased it and doubled it. It's still only paying out 25% of free cash flow. It raised it 16.7%. Again, this year we expect a dividend raise as well. Reasonable valuations is what we look for, and a growth and diversification plan in place. Let's look at their last quarter. Again, revenue up 38%, EBITDA 51, EPS, which we really like, up 250%. So our thesis summary here on the company: good yield, balance sheet for expansion, and this is key. Well, if it can replicate the success that they have in that one market in 3 other markets over the next 3 to 5 years, we could have a company with a sustainable growth plan ahead of it. Trades at low valuations. It is geopolitically risky. There is a discount for that, but the discount right now compared to the market is about 9 times versus the market at 19. We think fair value and its growth at a reasonable price in this market. Okay, the next company I'm going to talk about is a company we've recommended for years, back to 417. We think there's an inflection point ahead of it in terms of growth. Enghouse Systems trades around the $36 range. 45 is our target or fair value for the year. Pays a 2.4% dividend as well. They are a software company, call centers, and also asset management software. The real growth here comes from the balance sheet. They've just started to be able to deploy capital. During the pandemic, everything was too pricey in tech. They've come down. The last time we saw them pause for 2 years on acquisitions was back in 2006. They made 25 acquisitions over the next several years, and the stock price shot up. There could be a similar trajectory happening right now. Now, again, our thesis on this company: near-term growth is challenged, but acquisitions have pushed revenue growth positive. We should see EPS growth and a re-rating this year. $240 million in cash in the bank, no debt. So it can deploy that now at better prices. The macro environment is improving. Interest rates are higher, and it's harder for companies to get funding. They can go out, they have the cash, they don't have to borrow money, and they can grow that way. This just says essentially they trade at a discount to their peers, which is what we like, about a half multiple to their peers. We have a buy in the long and the near term on this company. Next company we're going to talk about here is VersaBank. Now they are a digital bank. They are a Canadian chartered one bank since 2002, using an electronic branchless model. We like the business here. They were at this conference, we recommend them as a top buy this past year. It's up 50%. We think it's really just getting started. We're not buying it for yield, but we see a tremendous growth path ahead of this business. Now, this is the last quarter. You can see their tremendous revenue growth and tremendous EPS growth is what we'd really like to see. 47 cents up from 23, and we're highlighting the Q4. Now, our investment thesis here, strong asset growth, 29% year over year, 6% sequentially to 4.2 billion last year. We estimate by the end of this year or early into next year, they could get to 5 billion. Growth catalyst, U.S. expansion. If they can replicate their highly profitable model in the Canadian market into the U.S. market, and we expect to see that sometime in 2024. Growth estimates here, EPS $2 for the year, that would be up 27%. Even just giving them a 10 times multiple, that would get you a fair value of 20. So growth at a reasonable price where you are. This last company is probably the most speculative of the group. It is Geodrill. They are a leading gold drilling company in West Africa and through Latin America. Trades around $1.68 right now, $2.50 to $2.75 we think is fair value. You can see they have a 10-year track record of strong growth. They took a pause on that growth this year. We think it'll be an opportunity for the second half of this year. They're a historically profitable gold driller. They do have a net cash balance sheet. They had a receivables issue. Some of the junior miners weren't paying them over the course of this year. It could get a little bit worse in the next quarter or the quarter following before it gets better. But we think that's an opportunity for a company that's well run and does have a history of good profitability. Growth resumes in the second half. Again, fair value $2.50 to $2.75. And it's a takeover target as well. We see it as a potential takeover target for a larger driller. And thank you. Aaron Dunn is incoming. You see what I've done there, Aaron? You see that? Incredible. Thank you. I'll just take this. If you want to talk to us too after, we'll be back at the booth there. Have a good day.
That's my clicker.
It is.
Perfect. All right. Thank you, Ryan. Hello, World Outlook. How is everybody doing? Great, great. So it occurs to me that I am the last individual speaker of the event. Does that mean that I'm the main event of the conference? Or at least that's what I get to tell myself. I know it's been a long couple of days. You've all absorbed a ton of information. You're probably exhausted. Worse yet, you've just been subjected to Ryan for 20 minutes, which I know is not an easy undertaking. So the pressure is on me to make sure that it's not the best. I just wanted to thank Ryan for the great work that he just did as the opening presenter to my main event speech. And by great work, I mean, Ryan, you really set the bar so low that it makes my job super easy. No, I need to be honest. Ryan, as always, did a terrific job. I've been working with Ryan for about 20 years, and I've witnessed myself firsthand his uncanny ability to discover these underfollowed, ignored small cap companies that everybody thinks are boring at the time and go on to produce tremendous returns. So there have been so many of them, and the Boyds, the Expels, the Hammond Powers, they're the extreme examples, but they're by no means alone. So I just have to give credit where credit is due and say, Ryan, when it comes to small cap discovery research, you set the bar sky high. Now, this is the first time I have ever complimented Ryan publicly, and I feel like I'm getting this. Okay, so let's move on. We've wasted enough time talking about Ryan. I'm here to give you the best advice that I can to help you be successful in 2024 and well beyond. But I have a confession to make. I'm not a fortune teller. I can't see into the future. So I don't know exactly where inflation or the S&P are going to be a year from now. I don't know what stupid decisions the politicians or the central bankers are going to make over the next year. I can definitely predict they will make some stupid decisions, but I don't know exactly what or how this is going to coalesce with everything else to influence the market. But what I can do is give you the advice that you need to build a portfolio that is well positioned to generate growth and cash flow and thrive in a wide range of economic scenarios. And you don't need to be a fortune teller. You don't need to wager your financial well-being on yours or anybody else's ability to see into the future. As I'm going to talk about 4 topics and how they should factor into your portfolio in 2024 and beyond. These are dividend growth stocks, commodities, US investing, and artificial intelligence. And I'm also going to add in individual keystone recommendations because that's what we do, of course, at Keystone. It's the core of what we do. First, should you invest in dividend growth stocks? These are companies that are producing a growing stream of cash flow for their investors and paying it out. The answer unequivocally yes. And the data on this is very strong. Dividend growth stocks substantially outperform. 35-year annualized return of 10.8% compared to 1.1% for non-dividend pairs. Substantial outperformance, but the data also shows that they're lower risk. Annualized volatility over this period, 13.3% compared to 24.5% for non-dividend pairs. So about half the risk as measured by volatility. Higher return, lower risk, that's a recipe for investing success. Now let's see what this looks like in practice. I'm going to use an example of a long-standing recommendation at Keystone's Brookfield Infrastructure. We picked up coverage in 2011 at 960. We've put out 33 buy recommendations since then. It's currently trading at about $43. This company has been a cash flow generating machine for its investors, paying out substantial cash flow every year and growing those income distributions every year. And this compounds for investors over time. So since we initially picked up coverage, the company has nearly tripled its income distribution. Total cash flow paid out to investors over $13 US compared to an entry price of 960 Canadian. And the yield on the original entry price, now 22%. That's the power of compound income growth. And this is something that a GIC or a bond can't replicate. Now, I think I could hear Michael Campbell whispering under his breath right now. He's saying, yeah, but Aaron, what have you done for us lately? And that's a great question because in investing, we always have to look forward. So this is when I introduce my 3 income recommendations of the evening. And first is Brookfield Infrastructure. I use this company because not only does it exemplify the income growth model, but also because we continue to like the business today. Excellent assets, essential assets, like ports, railroads, data centers, energy transmission, things that the world actually needs. Stable revenue generation, 95% contracted, regulated, 70% indexed to inflation. And the company continues to invest back in its business, making accretive acquisitions, organic investments to meet or exceed its long-term growth targets. So we continue to believe that this company is positioned for growth and for increasing its income distribution long-term. Let's look at what this could look like going forward. Right now, it's paying a yield of about 5%. That's about what you would get with the GIC. But the difference is that Brookfield is growing the distribution on an annual basis. So what does that look like using a reasonable 6% growth rate over 5 years? That's a yield of 6.7% on the entry price and 9% over 10 years. But you still have a business at the end of that that is continuing to grow, continuing to pay out cash flow. Recommendation number 2, Exchange Income, another long-standing company at Keystone. We picked up coverage in 2010 at $14. It now trades at $47, 31 buy recommendations. This company provides essential services like supplying remote communities under government contracts, medevac operations, and other services, infrastructure, and defense. And again, it continues to invest in its business, continues to grow, a tremendous track record of accretive acquisitions and growing its dividend over time, and a reasonable valuation. So much like Brookfield, it's been a cash flow generating machine. $28 in dividends accumulated paid out since our recommendation. It's about twice the entry price. So what happens going forward? 5.7% yield right now, 4% reasonable dividend growth rate brings you up to an almost 7% yield in 5 years and 8.4% in 10 years. Again, this is the power of compounding growth. And then finally, I can't come to the World Outlook Conference without bringing something new. So one of our newest recommendations is decisive dividend. This is an acquisition-focused company, and what they're doing is they're capitalizing on the demographic trend of aging business owners selling their companies and retiring. So there's a massive amount of capital that's expected to exchange hands over the next decade due to this demographic trend. And Decisive is performing well. They've made 5 acquisitions over the last 15 months, doubling their free cash flow. They're balanced between Canada and the US. They pay a 5% yield, and they grew that dividend 33% last year. It's a little higher on the risk spectrum than the other two, but it's a company that we believe is well positioned for future growth, and it fits that dividend growth. Okay, so let's talk about commodities. How should commodities fit into your portfolio? Now, this segment is not for me to tell you if you should or should not purchase commodities. At Keystone, we like to invest in companies that are producing a growing stream of cash flow, dividends that are innovating. Sometimes you can buy mispriced. What I want to do is I want to take a look at the data just so you can figure out how commodities should fit with what you're doing. So let's start with energy. The S&P Cap Energy Index. Over the last 15 years, it's up over 26%, 1.4% compound annual return. Next, we'll take a look at metals and mining. The Global Mining Index, a little bit better, up 3.6%. How about gold? 3.6% compound. So the Global Gold Index, it's actually down over 15 years, down about 15%. So these are stocks, but what about the actual gold price? Well, that's performed a lot better. It's more than doubled, up 115%, 5.2% compound annual return over 15 years. What about the S&P 500, the most diversified index of stocks in the world? Up 570%. 13.5% compound growth every year. Now, can we just naively extrapolate this data going forward? No. But we also have to consider the data and consider how commodities are going to factor into our portfolio. Should they be 50 or 60% of your portfolio? Or should they be closer to maybe 10 or 20%? We continue to make the case for value generating, cash flowing, profitable, innovative businesses as being the outperformers long term. Okay, let's talk about investing in the US. I assume that most of us are Canadians, although not all. I talk to a lot of Canadians, obviously, about investing. And one thing I notice a lot is a home country investing bias or an aversion to investing a significant amount of capital in the US. If this is not you, then pat yourself on the back. But if it is, then I advise you to reconsider. Let's look at what the data say. The US market substantially outperformed the Canadian market in 9 of the last 11 years. So this is the excess return of the S&P 500 relative to the TSX. And as we've seen, this compounding can add up over time. About 3.5 times wealth generation. Now, the biggest reason I hear from Canadians about not wanting to invest in the US comes down to currency exchange risk. But that's not a good reason. So this is the excess return of the US market nominally and also factoring in the currency. And what this tells us is that in only 1 of 11 years did the currency risk make investing in the US market a net negative. In some of those years, it did hurt you a little bit, but the US return was so much higher that return offset any decline in currency. Now, of course, we can't just extrapolate this data going forward naively, but there are very structural reasons why I think this is going to persist. So this is the Canadian stock market broken down into sector category. And some of you are probably seeing all this. We are hugely over-concentrated into just 2 sectors, resources and financials. We just talked about resources, financials, half of that's the big 6 Canadian banks. But look at where technology is. only 8%. And that's even a misleading figure because half of the Canadian technology sector is one company that has struggled to produce meaningful profitability. Let's look at the US market by comparison. Just broadly more diversified across the different sector categories. And right up at the top, technology. And the technology companies leading the sector in the United States, they're not struggling to produce profitability. They're some of the highest margin, most profitable companies in the world that are at the forefront of technological innovations reshaping society. So when we think about what drives economic growth, what drives market returns, a lot of that really comes down to technological innovation. And the major innovations over the last 50 years that have reshaped society, starting with the advent of personal computing in the 1980s, the internet, more recently, the massive advancements that we've seen in artificial intelligence, the vast majority of those come from the United States. So there are opportunities in the US market that simply do not exist up here in Canada. And you set yourself up at a disadvantage by not trying to access those opportunities. And with that, we segue into artificial intelligence. How do you invest in AI? And should you? So AI has been a huge theme over the last year and a half. If I go back to this chart, I really believe personally that artificial intelligence is the next wave of technological innovation that can drive the next leg of economic growth, improve productivity. And it's a major opportunity, but maybe not exactly in the way that most investors think. I see the opportunity in AI as more being how the technology transforms whole industries, making them more productive, more efficient. And it's less about actually investing in individual artificial intelligence companies. So we're going to talk about the reality and the hype of AI and the risks. But one thing that I want to say is that the advancements we've seen in artificial intelligence over the last year and a half have made it extremely easy to build an AI company. There are tens of thousands of applications that have been launching month by month. So if we were to look at the most popular AI app aggregation website, we can see here over 21,000 newly created AI apps featured in October alone. And any one of these can call themselves an AI company. The fact is, you don't even really need to know much about AI nowadays to start up an AI company. So there's the reality and there's the hype. So the reality is these major advancements, they are real. There is a step change in the technological innovation when it comes to AI. And this can truly reshape society in many ways. Like any technology, it can be for the better or it can be for the worse. But the hype is that AI has become the biggest buzzword in the stock market, bar none. Everybody's calling themselves an AI company. And this is a risk to investors. The reality is the competition is extremely high and the barriers to entry are extremely low. There's tens and tens of thousands of AI apps and companies coming to the market. And the reality is that the vast majority of them are never going to make any money. So how do you differentiate between real companies and speculations? Do what Jerry Maguire did. Ask them to show you the money. Are they producing revenue and profitability? This is what validates the business model. This is what sets you apart. If you're not producing revenue and profitability, there's better opportunities for speculation. So we believe in the current environment, and there are opportunities arising, but in the current environment, investors are best to stick with companies that have established competitive advantages in the AI space and a track record of producing growth and profitability. So two companies that I'm going to recommend here in the US technology sector, Microsoft and Alphabet, Alphabet being Google, as well as YouTube. Both these companies released financial results last week. Microsoft growing their earnings per share by 26%, Alphabet by 40%, tremendous growth for companies of this size. They have the competitive advantages to differentiate them, and they're trading at still reasonable valuations. I mean, Microsoft is a little more expensive now, but long-term, we still like it. But Alphabet 21 times earnings for a cash-rich business, leadership position in its field, and a significant growth. We think that that's reasonable. We think it's good value. So in conclusion, where are we at? Dividend stocks should play a vital role in your portfolio. Commodities, just don't overexpose yourself. Invest in the US market and be wary about AI and AI stocks. It's a huge buzzword. Stick with established technologies that are making money. And that's it for me. Well, thank you all very much. It's always a pleasure speaking in front of you. Come talk to us out at the booth. Best of luck in 2024 and well beyond. Thank you.